Gold is probably riding for a fall because the last two times it was anywhere near this was in the massive inflation, so double-digit inflation in the 70s, early 80s. I would make a shift from gold into Bitcoin because I do think the knocks on Bitcoin in the last year have been stablecoins are taking some of the role that Bitcoin was going to play in emerging markets. That's true. But that's not forever. That's just for the equivalent of a checking account. When they want real savings, they're going to buy Bitcoin, we believe, especially if it's a $1.5 million price target in 2030.
In every market cycle, certain assumptions harden into perceived truths. Investors repeat them, analysts build narratives around them, and over time they become accepted wisdom. Gold is inflation protection. Bitcoin is digital gold. Technology cycles always end in bubbles. Innovation always moves faster than fundamentals. Cathie Wood begins by addressing one of the most common misconceptions in modern macro investing: the idea that Bitcoin and gold are correlated assets. While the narrative is intuitive, both are scarce, both are often framed as stores of value, the data tells a very different story. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
First thing you should know, Bitcoin and gold are not correlated. We did the analysis. If you go over this cycle from 2020 to today, the correlation, so one would be a perfect correlation. Minus one would be an, inversion. When one goes up, the other one goes down. It's as close to zero as you can get. So no correlation. That's really important for everyone to know. If you look at the last two cycles, gold led Bitcoin. And then the third thing I will say is, if you'll find this on on X, Cathie Wood, a chart showing gold divided by M2. It has never been higher. It hit a new all-time high this week. Now it's starting to correct. I don't think it's because we put this chart out, but I will say what I said in there is gold is probably riding for a fall because the last two times it was anywhere near this was in the massive inflation, so double-digit inflation in the 70s, early 80s. And before that, the Great Depression, when gold, the dollar was devalued in gold terms from 20.67 to 35. That's a 70% devaluation. That's like emerging market kind of devaluation, right? Back in 1934, January 31st, 1934, the government confiscated private gold, didn't allow any more private ownership of gold, and money supply collapsed. Now, we're not in anything like either of those two worlds, and yet gold is where it is. I think if I were a betting person, and I can't give advice necessarily, but I would make a shift from gold into Bitcoin because I do think the knocks on Bitcoin in the last year have been stablecoins are taking some of the role that Bitcoin was going to play in emerging markets. That's true. But that's not forever. That's just for the equivalent of a checking account. When they want real savings, they're going to buy Bitcoin, we believe, especially if it's a $1.5 million price target in 2030. That's our bull case, is right. And this idea, digital gold, it's better than gold, actually. You know why? Because the supply, yes, that's critical. But the supply, in terms of monetary policy, the supply growth of Bitcoin is 0.8% per year, and it'll drop to 0.4 in another 2 years. I'll bet you a lot that gold supplies are going to be up much more than that. Their average over time is 1%. So I think with intergenerational wealth transfer, that Bitcoin is going to take off here. Very few people know this, but because there have been so many other things to worry about. But on October 10th, there was the flash crash caused by a software glitch at Binance. And there was an auto deleveraging event. People were just, margin called to the tune of about $28 billion. We know some of the entities that were caught up in that. They were caught flat-footed. And we think that is just now washing through the system. So if you're looking for something that has weighed on it recently, we do think that happened. Bitcoin's the most liquid of all crypto assets, so it's the first margin call, right? And we think that's pretty much worked its way out. So we're testing here around 80,000 again. We think that we're going to hold in the 80 to 90,000 range unless all hell breaks loose in Iran, let's say. And then maybe we'll see the store of value come back for Bitcoin.
Beyond crypto, Cathie places artificial intelligence at the center of a much broader economic transformation. AI, in her framework, is not just another technology. It is the catalyst that accelerates every other innovation platform. One example is autonomous mobility. Robotaxis are not simply vehicles. They are robots, powered by AI, dependent on energy storage, and enabled by massive data processing capabilities. None of this was economically viable a decade ago. Today, falling costs and technological maturity are bringing it into reality.
AI is the catalyst to all of the other innovation platforms, to speeding them up as well. There's a great convergence taking place. So if you think about robotaxis, it's the convergence among robots. Robotaxis are robots, obviously. Energy storage, they will be electric. And AI, they'll be powered by AI. They couldn't exist without AI. And we think that that's going to scale to a global revenue generation opportunity of more than $10 trillion in the next 5 to 10 years, from almost nothing today. And another example of convergence is in the healthcare space. Many people don't think about technology as much or AI as much when they think about healthcare, but it's probably the most profound application of AI, and it's the convergence of sequencing technologies, including single-cell sequencing. We each have 35 to 40 trillion cells in our bodies, and now we're going to be able to sequence down to the cell level. So sequencing technologies, AI, and then CRISPR gene editing, which is able to edit out programming errors that we are now able to find thanks to the convergence between AI and DNA sequencing, well, all kinds of sequencing. There's a huge wall of worry. The strongest bull markets are climbing walls of worry. I remember I was in the internet, well, the tech and telecom bubble, as it's called, and there was no worry at all. The only investors worrying were value investors because they thought they'd lose their businesses, right? And they ended up having the last laugh back then. But the most senior portfolio managers and investors in our industry today, they were fairly young during the tech and telecom bubble. They now have the gray hairs and they're saying, been there, done that. I am not going to get caught in that kind of a mess again. So we have, 2 steps forward, 1 step back as you get that kind of worry. And the reason we think this is not like the internet is because we have so many technologies now. Back then, as you say, we had come off sort of the PC and PC software cycle into the internet age and then into mobile. But we didn't have 5 major platforms evolving at the same time, and they involve 15 different technologies. So the 5 platforms are robotics, energy storage, and AI, and of course Tesla is the poster child capitalizing on that one. The other 2 innovation platforms are blockchain technology and multi-omic sequencing in the life science space. What we are expecting is the convergence of these technologies will be like S-curves feeding S-curves. So in most technologies, they evolve slowly, then all at once, right? Well, we're having all of these technologies. Yes, it's taken a long time for autonomous mobility to get here, really. We were talking about it at the founding of ARK in 2014. But it is here, and part of the reason is robotics, energy storage, and AI have developed enough, have evolved enough so that their costs are low enough so that we're ready for prime time. I'm going to give you an example of how ridiculous in the tech and telecom bubble it included biotech. And there was this dream of personalized medicine back then. Why? Because we were close to sequencing the first whole human genome. Back then, it cost $2.7 billion to sequence one person's genome. Today, it costs $100.
Wow.
Think about that, right? So from 2.7 billion to 100, we are ready for prime time. The technologies are ready and the costs are low enough. This is where we're going to learn a lot. I think the pendulum shift is going to move back to longer term time horizons. What many analysts are struggling with right now is the short-term time horizon they have. You know, I want my profits now, I want my dividends now, my share repurchases now. And unfortunately, it is going to take some time, partly because of the supply chain issues. We're seeing TSM, you know, it was interesting. TSM's CapEx was stalled at roughly 10 billion, right? And we were thinking, okay, is TSM signaling that there is an inventory problem looming out there? Well, I think they just jacked that up. Didn't they jack it up to, I forget what the number
40 plus. Yeah.
Yes, quite significantly. And they're extremely cautious. They've been through many cycles. And what they do is they go to the customers of their customers. That's how paranoid they are about this inventory situation. And I think they learned as they were doing that, wait a minute, what's happening is the applications associated with AI are so broad, so profound, and the productivity changes are so enormous that, you know, they began to understand, wait a minute, this is a revolution. It's a revolution. We actually think the payoff is from our point of view, we have a 5-year investment time horizon. And we think the payoff's going to be not 5 years. We're going to start seeing, we've already started seeing productivity gains. We've said for some time we've been through a rolling recession. Manufacturing's been down for 3 years. Housing's been down for 3 years. Small businesses terribly depressed for 3 years. That is all starting to change. But productivity, partly for that reason, companies have been focused on efficiency gains. And so productivity is close to 2% on a year-over-year basis, which is fairly strong for this time in the cycle. We think that's going to accelerate to the 5 to 6% range as manufacturing comes back, as, you know, the entire global economy recovers from, I think, the vestiges of an interest rate cycle that really hurt. And while GDP didn't show it, and so if you don't dig beneath that headline growth rate, you can't understand this. When you talk to companies, you definitely understand it.
Cathie Wood's message is ultimately about alignment, aligning capital with the scale and direction of change, rather than the comfort of familiar narratives. Bitcoin is not gold. Gold is not obsolete. Innovation is not a bubble. simply because it is disruptive. And economic transitions do not unfold neatly within quarterly earnings cycles. The convergence of technologies underway today is reshaping productivity, markets, and monetary systems in ways that require patience, long-time horizons, and a willingness to challenge assumptions.